Good Monday morning, good Monday afternoon, and welcome to the Short Vol Show. My name is Dave, and I'm happy to have you here with me today. In the market today, exciting goings on as we continue to roll through with earnings. Now, I'm happy that all of you, or a lot of you, got to see the Tesla calendar spread video over the weekend. If you haven't seen that one yet, check it out. It's my most recent video with the picture of the Tesla in it, and I talk about how with just a couple $1,000 you can set up a calendar spread in Tesla and hang out and collect money every day. It's a trading idea that you can apply to many different stocks and something for your toolbox, so check that out. News to report is that we have almost hit the all-time low in UVXY again. Now, this has been over 200 days since we've taken out the low, so this will be a monumental or a momentous occasion, I guess you could say. UVXY did get as low as 858 a few minutes ago. Now, to remind you, the all-time low is 852 of, as I said before, over 200 days ago. So that was quite some time ago. But regardless, we are close to reaching that level again. Meanwhile, there's earnings, and earnings continues to roll along. I've been active with the earnings situation because I do need to do something while UVXY really isn't moving too much. Now, right here, you know, it's hard to initiate a short vol position. Now, for me, I only am either short or I'm flat. So it's hard for me to initiate a short position with the VIX trading 1130 because that's kind of around the lowest level it's been in some time. And you don't really want to initiate a short position at the bottom of a range. Now, we know that these that UVXY, VXX, TVIX are decaying rapidly. And a lot of the reason for that is, of course, due to the term structure. So if we take a look at the term structure now from VIX Central, you can see that we've got contango of over 10%. Now, remember, actually, you can't see that at all because I'm right in the middle of the way of that. So let me try to move myself out of the way here a little bit so you can see. There, that's a little bit better. So what are we looking at here if you're new? Well, we're looking at a chart that compares the various VIX futures to one another. And you see, as you go from left to right, the first future is the August future trading 1310 here, otherwise known as the M1 future. The second future out is the M2 future, otherwise known as the SEP or U future. That's trading 1446. So this area underneath the futures, between the futures and the spot, which is 1131 here, that is the area of convergence. That is your potential to sort of make money to the downside here. And I sometimes like to draw on this to illustrate this. So let's play with our little pointer here. I love the snipping tool. I'm using the snipping tool that comes with Windows. It's a neat little tool where you can capture any window and save it. It's a quick way to capture anything that's on your screen and save it to maybe upload it to StockTwits or elsewhere. But in this case, I'm using it to draw. So this area here that I'm drawing between the futures and spot, this is going to converge here. Now, if spot does not move, then the futures will be kind of sucked down towards it, as shown by the down arrow here. And this is all going to help you to the downside, okay? So this is why, part of the reason why I never get long this, even when the VIX is low, because this is fighting you all the time. Now, right now, we're into August already, so where are we on this chart? Well, we're actually, we're farther in on this chart than just the August future. And the reason I say that is because UVXY and TVIX and VXX are based on a blend of the two futures. So as we move through the month, it becomes more based on the second month future and less on the first. The reason for this is there always needs to be 30 days of future there has to be 30 days out total of futures for to emulate the VIX 30 days. So if you've got the SEP future is 28 days out, then the August future will be 2 days worth, and so on and so forth. So where are we right now? Well, it's August, I don't even know what date, August 6th. So we are kind of like right here on the chart maybe. And so that distance right there, which should be a straight line, but I didn't draw it too well, is our potential money to be made. So if you look on this chart, you can see that there's $1.80 between spot and, or $1.79 between spot and the front month future. That's pretty rich for halfway through the month. You'd expect it to be more around maybe like $1 right now. And so on top of this 10% contango, there is a lot of room here for this to just collapse. And that's why I don't want to be long the VIX here. Even with the VIX price relatively cheap comparatively to other things. Let's take a look at the VIX chart just for a second here. I don't want to be long it here. In fact, I would prefer to be short if anything, but I do have a neutral position now just for disclosure. I would love to short this on a pop. Now remember, if we do get a pop in the VIX, contango will come in a little bit, but that would only be temporary. So here's when you look at the VIX now, you see we are pretty, we're at the low end of the range in recent times, you know, unless you go back before February, we're at the lowest point. So probably don't want to initiate a short, and if you're a long, if you like playing it to the long side, you know, you might even want to get a little long here and play for a pop. I know that's something that maybe my friend Sal might be into, but despite that, there is decay on this. And 10%, when we see that 10% number, that's not 10% per year. Usually when you see like a loan rate or something, it's per year. Well, here we're talking about per month. So that's 120% per year that this is decaying right now. So a lot of pressure on this to move lower. So think about that when you're deciding if you should get long the VIX or not, because it would be, in a perfect world, you could get long the VIX when it gets low and it would just pop. But we don't have a perfect world because there's no perfect way to emulate the VIX, and so you have the VIX, and so you have to use these futures, which don't do a great job at following the VIX because they decay rapidly. And this is heavy decay here. 10% is the high end of decay. So time to be careful here. If you're going to get long, you have to time it exactly right. Otherwise, you've got that decay coming against you. Now, I don't want to overstate this because 10%, okay, that's per month. So what does that break down to per day? It breaks down to, 0.3% per day or something. So if the VIX were 10% a month would mean it's decaying by $1 a month. So that means if you divide that by the number of days in a month, that means it's only decaying like 3 or 4 or 5 cents a day at most. So it's not a huge force pulling down. It's not super huge, but it is there. So that's something to be wary of. Now, what have we got going on for earnings? Well, Facebook made a pretty big move up so far today, up $6. That stock's sort of been rebounding since the earnings debacle where it ripped down from 218 down to 170. I think it closed like around 178 the day after earnings. But on the comeback trail here is Facebook, as you can see from this chart here. Hopefully I'm not too far in the way of this chart. Meanwhile, Tesla, which we were following last week, we were talking about putting the spread on and then maybe adjusting from time to time as Tesla if it were to move too far away from the strike. Now, the spread that I was talking about putting on was I'm showing you what I'm doing here is that the top of the screen there is this link, and if you match the link to the link at the top of this other screen here, then when you select a stock, it will automatically bring the chart up for it. Every once in a while, this link thing comes unattached for some reason. You have to go back and redo it. So that's what I was doing there. So if we go back to Tesla, we were talking about doing a calendar spread and centering the spread around where you think the average price of Tesla will be. And so the spread I was discussing on, what was it, Sunday, was centered around the 340 strike, and indeed that would still be sort of valid now. We've only moved up 80 cents since then. We were a lot higher. We were up, I think, $6 earlier today in Tesla, and I was sort of thinking about, well, maybe I should be moving my spread up to the 350 strike because we seem to be hanging out around there. But here's the story of the day so far in Tesla. Just making sure that I'm not once again in the way. I find myself often in the way. Somebody was saying that, why is Moby talking about stocks? And I'm done cutting my hair. I'm letting it grow back. I've had fun for like 6 months, but letting it grow back now. Anyway, Tesla hanging nicely. If you had the spread on, you're making money today because just hanging out. That's what we like to see when we're short premium in a stock. When we're net collecting, we like to see the stock not move much, just hang out. And it seems to be just hanging out here. It did get up to 355 earlier today, but with a short premium position, it's tough because you need to be able to take heat both to the upside and the downside and not panic and just assuming it comes back, you're fine. If it just keeps going in one direction and never comes back, that's where you can get yourself into a little bit of trouble. But you're going to have to figure out yourself what your sort of risk tolerance is and what you feel comfortable with, and sort of trade in ways that you feel comfortable with. If you can't sleep at night because of a trade you have on, then you've got too much risk on. That's a good rule of thumb. So what earnings do we have today? I believe we've got Twilio, Etsy. I had this neat list of earnings. I'm going to try to find it for you right here. I posted on StockTwits. I got it from somebody the other day. Let's find that one. And because I like to see what earnings are coming out, seeing if there's something that really catches my eye that I might want to play. Because earnings is an exciting time. Stuff moves around. You do get some higher volatility issues out there, and might as well jump in and have some fun with it at some point. So let's see what we've got. If I can find my little chart. All right, maybe I can try it this way. Earnings calendar. Morningstar, Bloomberg. Well, I do know that we have Etsy today, and I'm not quite sure why my earnings calendar is not coming up. But I do know that we have Etsy today, and we've got Twilio, and we have some other issues. So let's take a look for a second at Etsy here. Now, we know that with options we can, now this is the daily chart of Etsy. We know that with options we can participate in like a $40 stock without having to pay $4,000 for 100 shares. We can do that by buying in the money call. So for example, if we look back over time in Etsy here, and we see that there have been a lot of earnings breakouts, and I'm not sure that there have, but okay, so here's earnings here, not a whole lot. There was that big breakout, but that wasn't earnings, that was something else. Let's back this up another couple. So earnings, so we had a rip on this earnings here, we had a rip on this earnings here, we had a rip on this earnings here. So we've had some rips on earnings. Now, this stock has really exploded in the last couple of months, so hard to tell what's going to happen, and I'm not going to make a call. But let's say you were making a call. Let's say, for example, that you thought that this run-up was overdone and that this thing is going lower. Well, what could you do? Well, you could buy puts, of course, or you could buy a put spread to limit your risk even more. So let's say, so stock's 42. So you could buy maybe a September with 46 days to go put spread. You could buy maybe the 35-30 put spread and pay 70 cents. So you're paying 70 cents to make 470 if it crashes down. Now, I don't necessarily like that one too much because it's going to take a lot for it to crash down. I would probably prefer, let's see. Let's take a look at front month put spreads. No, you could put the 40-35 spread on for a $1.50. So you're betting $1.50, so $150 each time you put it on to make $3.50 if this goes to 35. Could this reasonably go to 35? Of course it could. Now let's say conversely that you think that this is going to beat earnings and it's going to do great, or regardless. Now remember, folks, earnings can come out and earnings can be good, good, in line, or bad, and a stock can go up, not move at all, or go down. It really is hard, even if you knew ahead of time what Etsy earnings were going to be. It might still not tell you which way the issue is going to go. But for example, if you thought this was going to rip higher, you could buy something like the you could buy the 45.50 call spread for $1.10. So bet $1.10 to win $3.90 if it goes to 50. You could buy the and if you're looking at front month, if you thought this was going to go lower, you could even buy the 35.30 spread for 50 cents. You're only betting 50 cents, but if you get a big move down, you can make $4.50 on it. So when you're looking at these spreads, notice I look a lot at just risk reward. How much am I betting to make how much? That takes out of the equation volatility and everything else. It doesn't matter if volatility gets crushed or not. When you're still on the spread here, you're still betting $1.50 to make $3 on the 40-35 put spread. It doesn't matter what volatility does. If you pay $1.50, the most you can lose is $1.50. The most you can make is $3.50, and that can be simpler for people to kind of understand. Let's take a look at Twilio for a second, and the symbol is escaping me, so I'm gonna look it up. I have a friend who trades this TWLO. Well, that's simple enough. TWLO. All right, so it's a $62 stock. When I pull up my chart here, I'm going to go to implied volatility just to take a look at the options vol. Okay, so with 4 days to go, 140 vol. Now remember, when you have an option that only has 4 days left, these volatility numbers are not that meaningful. You want to look at like the dollars really for options premium. So 63. So let's take a look at the 70 call, which would be up $7, $1.32. That seems pretty rich. So if you like this, actually this all seems pretty rich. You could maybe sell a strangle in this, and as long as the stock stays within a certain amount. So let's say you could sell a call that's $10 out of the money, so maybe, or more out of the money. So maybe the 72 call for 92 cents, and you could sell a put that's $10 out of the money, so maybe the 52 put. So if you sold the 53 put, for example, I'm sorry, if you sold the 52 put, so I'm clicking on the bid for the 52 put, and then I'm going to go up to the 72 call, and I'm going to hold down control, click the bid on the 72 call. Okay, now you're selling a strangle for $150. So if this makes less than a $10 move, you are going to collect that $150 each time you do this trade. Now, if it starts to move through one of the strikes, you're going to start incurring risk. But in the meantime, if it stays in between the strikes, you'll collect $150. And that's not actually a bad spread because this is pretty high vol, 135 vol here. Now, there's a little bit of a skew like there is in every stock. So the put is showing 140 vol. But once again, these vol numbers in one day, this option price of 53 cents, okay, if this was 1 day later, that would actually be a way higher vol. So tomorrow, well, I mean, it doesn't matter because volatility is going to collapse overnight for earnings anyways. But let's say earnings was 2 days from now. If 53 cents would represent, with 1 day less to go, would represent a much higher vol. It would probably be higher than 150 vol a day from now. So look at the vol number, but more importantly, look at the premium and say, well, does it make sense to me that this put is worth, a put that's $10 away in a $62 stock is worth 50 cents. Does that sound rich to me? Does that make sense to me? Is that something I want to sell? And evaluate it that way. Don't just use volatility, because like I said, volatility is going to be, these are dollar cheap options, and there's only 4 days to go. So volatility is much more meaningful as you move out in more vague intensive options like October or January. And you can indeed see that like September volatility is way lower. It's in the 60s here. If we do go to our Analyze tab here, we can take a look at what the historical and implied volatility are. And I'm going to guess that we were pretty high. Yep, we're in the 84th percentile as far as volatility in this issue. And it's showing current historical volatility 58%, current IV 84%. Now, this 84% number comes from a combination of what we saw, that huge number, 134, 135 in the front week, averaged with the farther out months, which are down into the 60s and probably even into the 50s as you get farther out. Let's take a look at Jan options, for example. And indeed, Jan options at the money are in the 50s, so much lower than the front months. And that makes sense, but these will go lower even as soon as earnings are released. So this is some fat volatility here, folks. And even if you go a week farther out, look, the 70 calls with 11 days to go, or the 70 calls, $1.70. That's pretty rich. So if you really like the stock, maybe you would do this buy right, buy 100 shares and sell one of these calls way out here. Now, remember, the buy right is going to give you some serious downside risk if you were to do that trade. That was why I would be kind of careful about doing a buy right here. But just a trade idea in Twilio. These prices are pretty rich, and let's take a look actually at the at-the-money straddle. So stock 63 now. It's interesting to me that these weeklies have options every 50 cents. That's pretty amazing. So the straddle is trading about, it looks like it's about $8 bid here. And when you look up on the side of the screen, predicted move here, 710. Well, the options are predicting an $8 move here in the next 4 days. So I don't know. It seems pretty rich to me. $8, $62 stock, $8 straddle. It could go above that, but you know, what you could do is you could do something like sell the straddle for $8, and then to protect yourself, buy maybe if you're really afraid about the upside, sell the straddle for $8. Maybe buy something way out of the money just on an emergency move of maybe like the 72 or 70, maybe the 80 call for 20 cents. That way, just protecting yourself against a doomsday move of that it really rips. Same thing to the downside. Now, if we sell a straddle and then we buy this protection on the outside like this, well, what are we really doing? Well, it's more like buying a butterfly, right? Because you're long 2 of the option right in the middle, and you're short 2 of the option in the middle, and you're long the wing. So you're kind of turning it into a butterfly if you were to buy these wings. So I don't know. Twilio looks pretty rich. It's a $60 stock with a high vol. So that's it's something that's interesting that you might just want to check out. Let's go to Canopy Growth. Now, these MJ stocks not really doing a whole lot. Kind of disappointing lately, the MJ stocks. Not a whole lot of vol. Haven't really been rallying back. For some reason, although I'm a terrible stock picker and never like to pick direction, I was thinking that we were going to see these things really be on the highs and be rallying. Really hasn't happened. I guess we need a catalyst. Now, this chart of 3 years does look very good. Certainly looks very good as far as bullish, that it's going to go higher, but a little patience is required at this point, I believe. Afria, I got into Afria around $9, and I've just been kind of bag holding and sucking wind on this one right now. I encourage you, check out volatility views on the Options Insider Radio Network. Mark Longo is great and was gracious enough to invite me on the show this week. That was last Friday, but it will be up on the Options Insider website, and I encourage you to check out the other shows on Options Insider. Mark Longo and company, Gene, and everybody else there are really cool, and more importantly, they've got great information that can help you make money trading. So do check them out when you get an opportunity to do so. I've got 3, maybe 4 people coming in for interviews this week, so exciting week ahead for you here. Please check that out, and we will continue to talk about different options trades and different earnings plays as we move through the week. I want to check out Match.com and Cheniere Energy. There's a whole bunch of other earnings that I want to take a look at very soon. Earnings estimate. And I'm just kicking myself that I don't have my little calendar here. I should have known where to get my little calendar. But maybe I found it again. Let's see. Okay, so here we have coming up today, Etsy, Weight Watchers, Twilio, which we already checked out, Marriott, my head's in the way, Hertz, Zillow. Let's take a look at Zillow just for a second. So ZG. I think it's kind of embarrassing that you can see. I wish you couldn't see everybody's houses and how much they cost for public information. It seems like that should be private. I don't know. Zillow off the highs, but it looks like it's kind of sort of in the low end of this band. Now, once again, I am not a stock picker, so if you want a stock picker, look to somebody else. I think you should make your own choices as far as those sort of things go. But look at the run up in Zillow. Let's take a look at options prices in Zillow for a second and see what we find. It's funny, some people have criticized me for not having the smoothest show, this and that. But the thing is like we are going live, we're live and on the fly checking out new ideas, and sometimes when that happens, it works out great. Sometimes there's pauses or I can't find something, this and that, and that's just part of the process of having a live show. So I apologize for those moments when I'm not talking or when I can't find something I'm looking for. But look at the contrast here between Zillow stock and Twilio, okay? Similar prices, sort of. Twilio was, 62? This is 59. But the volatility here, way lower, okay, in the 40s. Well, actually, that's a month out. Let's look to the front here. So no weekly options in this one. Yeah, vol in the 40s compared with 130. So to sell the $10 out of the money strangle here, you're barely getting like 40 cents for it. So that's where we stand here. Much less rich here. Now, of course, remember, volatility is based on how much these things move around, and it's much more likely in a Twilio that you're going to get that bigger move. We're showing expected here 511. Let's take a look at the money straddle. Stock's 59, so that would probably be the 60 straddle. Okay, so we're looking at basically $5 bid, where the other one was $8 bid. So a lot less vol here, really. And it looks like I kind of like where this is to sell a straddle when you just look straight at the chart, because it's kind of in the middle of a range where it's been trading, where it wouldn't be surprising if we went out and took out the high, possibly. Wouldn't be surprising if we moved a little bit lower, but likely that, it seems like we could just stay in a range. So maybe not the worst to sell. Now, I just want to offer a word of caution to people. Selling a straddle is a risky thing. You're selling a naked call and a naked put, and if it gets away from you, if it goes really far, you can lose a lot of money. So I'm outlining some ideas. When I talk about the straddle, it's really more to illustrate where the option pricing is, and does the option pricing sound like it makes sense to you, and you can look at the straddle to help you price other options, like, well, do I want to sell an out of the money call? Do I want to sell a put? Even a time spread, this sort of thing, or even possibly a vertical. Although, as we talked before, verticals can be better to look at as far as risk reward than volatility, really. Although, if you have like a step vertical, it is going to be affected by volatility, because that fatter option that's closer to at the money is going to be affected by volatility. It's just the way it is. So, for example, if you were to buy a call vertical and a day later nothing's really moved, but vol's come in a lot, you will have lost a little money on that. Ultimately, as a market maker, it can be hard to evaluate positions, because you have positions on many different strikes in many different months, and that's when you can go back to your Analyze tab and just look at your Greeks, as opposed, if you do have a bigger position where you've got lots of options trades together, as you're evaluating individual trades, you're going to look at things like risk reward, volatility, this and that. But once you have a position of many trades and you're looking at your position of many trades, you're going to go back to your Greeks and say, what are my overall Greeks? What's my delta, gamma, theta? And then you're going to dig into where does my delta, gamma, theta come from? Is it coming from this strike that's out of the money? Are they soft deltas, hard deltas? How are they going to be affected? What options are these Greeks coming from? But you're going to be much more reliant on just your overall Greeks once you have a position of many trades, as opposed to just evaluating a single trade before you decide whether or not to put that trade on. So back to Zillow, much lower vol stock than Twilio, but with a lower vol stock, you might want to consider, if you feel good about a direction, you might want to consider actually buying an option naked, like a call or a put. Now, I'd be hesitant to do that unless you really have an opinion, because this stuff is going to collapse right after earnings, and many times these things are reasonably priced, but not always. They get it wrong a lot of times. They're just using models and maybe tweaking them a little bit to get these prices. But if somebody really knows their stock well and its behavior, they can sometimes see how these things are sort of mispriced. Let's go back to our little list of earnings that we had here. Okay, so Oasis, Tenet Healthcare. We can take a look at Tenet Healthcare here. THC, that's kind of a funny name, THC. It's like the compound from marijuana. Now this much more high vol stock, showing in the 130s. Vol getting up there a little bit as we come into earnings. So stock's 38 at the money straddle. Okay, so 240, 160. So $4 bid for the straddle. If we go to our statistics, we're in the 62nd percentile, so not really super bid up for earnings. Nobody seems to be really making a bet one way or the other. I mean, as far as like buying options. Let's take a quick look at our open interest here. Open interest is going to tell you how much stuff is trading, and indeed, not a whole lot of open interest here. The 40 strike, there's some, but not a whole lot of options trading. When you see stuff like this, where there's like one strike's got 11, the other's got 29, 30, that to me means be careful, because there's not a whole lot of liquidity here. There's not a whole lot trading. The markets are going to be wider. It's going to be harder to get in and out of stuff. It's probably not the stock that you want to start out trading in, because you're not going to be able to buy stuff mid-market. Now, this market on the 40 calls, it's 10 cents wide. That's decent. And some of these things, like, they'll let you in. You can get into a trade mid-market. If they see it's opening, they'll let you in. But when you try to get out, it's going to be harder to get out of it. So, these markets look fairly tight to me, actually. But there's not a whole lot of volume in this stuff. And it doesn't seem like there's a whole lot going on. If there's not a whole lot going on, that could be a good a good spot to sell some options because it's not like somebody's in the know and buying a bunch of puts or a bunch of out of the money calls or something. Let's move on to some of these other earnings real quick. And let's check out Weight Watchers maybe. I'm going to switch my chart back to implied volatility. Okay, so Weight Watchers. So $92 stock. And I just can't help but thinking about Oprah owning this. And, when she bought it, and it's gone to like 100 from when she bought it. So huge win for Oprah. Looks a little scary, this chart here. This thing could get up and truck around if they miss really badly. But there's some meat on the bone here now. It's showing $9 for a move here. And when we look at the straddle, okay, it's a $92 stock. So if you look at the straddle, it's like $11.50 bid for the straddle, $11. It's a pretty rich straddle. If nothing happens and you sold a little bit of that, that would be a big money deal. There's some rich options in this one in the 80 vol range. If you go to SEP, it's in the 50s. And when we look at let's go to our Analyze tab here and take a look. So we are in the 60th percentile. Current HV percentile 0. So this thing, what that means is that this thing's hasn't been moving a whole lot lately. That doesn't really make sense to me. Why would it be 0? But let's go to like a 20-day view. And indeed, when you look at a 20-day view of this one, you see it's not been moving around. It's just been hanging in this range here for a while. Now, it could spike one way or the other during earnings, and it might. But I mean, if you were short the straddle, the 92 straddle here, you're banking for weeks at a time because it's not doing much of anything. Let's back this out a little bit further to the 180-day, and it usually has been moving a lot more, but in the last couple of weeks, it's just been hanging in this range here. And if it continues to do that through earnings, this will be a huge win to be short premium in coming out of earnings. It's just a question of what your risk comfort is and how you feel about it. But Weight Watchers, yeah, the actual volatility of the stock has just been hanging out in this area for a while now. And if it continues that way, short premium's the winner on this one. All right, so we've covered a lot of ground today, folks, and I hope you've gotten a little bit something out of this. Obviously, and hopefully you just get a better feel for some of these issues and sort of how to evaluate them coming into earnings. I appreciate you watching the show, and like I said, there's going to be some great interviews this week with many people far smarter than I am. And that's always an exciting thing for me because I always learn something. So come along with me and learn something as well, hopefully. And I'm going to leave you with my favorite little song here, and see you tomorrow. I do have an interview tomorrow morning, which may or may not be live at 9 a.m. Eastern Standard Time. So join me then if it is live, and that would be fun. It's one of a repeat guest who always is interesting to watch. So please come and check that out.